Hello everyone. Welcome back. Today, we've got some crucial news you don't want to miss. Let's dive right into the top financial headlines and break down what's happening. Decade of big S&P 500 gains is over, Goldman strategists say. Goldman Sachs has sparked quite a buzz lately with their latest insights on the S&P 500. According to their strategists, the impressive bull run we've enjoyed for the past decade has come to an end, and they predict that our annual returns over the next 10 years will drop to just 3%. That's a huge conversation starter. So, why is this significant? Well, it ties back to the Federal Reserve's current rate normalization process. They're not really in a traditional rate-cutting cycle. Instead, they're working to bring rates back to a more typical level. This shift raises some big questions for investors. How will the US market perform in this new landscape? And it's not just US investors who are concerned. The American market is a major barometer for global trends. Recently, Wall Street has been buzzing with debates about whether the three-year bull market we've seen will continue or if we're at the beginning of the end. But Goldman Sachs is encouraging us to think beyond just the immediate bull market and consider how the broader capital markets will react during this transition. Their report highlights that as investors shift toward bonds and other assets for better returns, it's unlikely that the US stock market can keep up the high performance we've seen over the last 10 years. Strategists like David argue that while the S&P 500 returned an average of 13% annually in the past decade, we should only expect about 3% in the coming years. To put that into perspective, that's significantly lower than the long-term average of 11%. Interestingly, they also point out that by 2034, there's a 72% chance the S&P will underperform Treasury bonds and a 33% chance it will lag behind inflation. They're urging investors to brace for stock returns that are more in line with the lower end of historical performance. Looking back, the stock market's rise after the global financial crisis was primarily fueled by near-zero interest rates and, more recently, by resilient economic growth. Bloomberg data shows that over the past decade, the S&P outperformed other global markets in 8 out of 10 years. However, a whopping 23% of that rebound came from just a handful of big tech stocks. Even if this trend continues, the S&P's returns are still expected to be about 7% below average. Now, I've got a couple of thoughts I'd like to share with you all based on this news. First up, whether you're investing in the US, China, or anywhere else, it's essential to think long-term. What do I mean by that? If you're in it for the long haul, you need to have a clear understanding of investment cycles. For example, China has its own rhythm. Even in a tough market, you can expect a little bounce every 5 years or so. In the US, these cycles typically span around a decade. Understanding these cycles is super beneficial, especially for younger investors. If you face setbacks, don't get discouraged, you've got time on your side. Just remember, learning the right investment strategies and sticking to a disciplined approach is key. Even if you hit a rough patch that lasts 5 or 6 years, hang in there. You'd be surprised how many people miss out on massive gains just because they gave up too soon. On the flip side, for our older investors, having a sense of these cycles can help you assess risks. Sometimes, people put too much faith in their own experience, but in the world of stock investing, age can be a double-edged sword. Recently, some experts have argued that older investors should reduce their stock exposure. Why? Because, frankly, they don't have as many cycles left to recover from losses. After age 50 or 55, it might be wise to scale back on stock investments. Second point, I know some of you hear mainstream media and think it's all fake, especially when it comes to opinions from big firms like Goldman Sachs. But let's be real, if you approach the world with such a narrow mindset, you're missing out on valuable insights. Goldman and firms like it provide their clients with guidance based on research and analysis. Sure, not everyone has the same level of experience, but their private banking clients benefit from direction in their investment choices. Ultimately, the responsibility for making decisions and facing the consequences lies with the investors themselves. So, while Goldman might send out guidance, don't just dismiss it because you think it's biased. Instead, sift through their insights, consider different perspectives, and adapt your strategy based on real-world changes. Goldman publishes reports every day, some of which get media attention, and some don't. Plus, different teams within the firm offer various viewpoints. Simply labeling everything Goldman says as false reflects a lack of understanding of how to leverage this information. I'm not saying you should take everything they say at face value, but dismissing them entirely as a reverse indicator isn't realistic either. In conclusion, making sense of market cycles is crucial for investors of all ages. It's about understanding the context and finding a balance in how you interpret the information available to you. Next, let's focus on the approaching US election. Bloomberg just published an analysis on what the upcoming US election means for the markets. With the election just around the corner, we'll be sharing more insights as we get closer. Our channel focuses on the financial aspects of politics, rather than just the heated emotions surrounding it. So, how do capital markets view the US election? What kind of impact will it have before and after voting day? Understanding these factors is crucial because they can help you identify trends and make informed decisions about your investments. According to the article, we're only a few days away from one of the biggest events of the year, the presidential election on November 5th. With uncertainties surrounding interest rates, the labor market, and global conflicts, the competition between Democratic candidate Vice President Kamala Harris and Republican former President Donald Trump adds another layer of volatility. While polls show a neck-and-neck race, investors haven't let uncertainty get to them. The S&P 500 has reached 47 record highs this year. Historically, election years have generally favored the stock market. Since 1960, the S&P 500 has risen almost every election year. In the most recent election cycles 2012, 2016, and 2020, the index gained at least 10%. So, there's no need to panic about this year's market performance. However, there's an important note: close or contentious elections can introduce risks. If the results are tight and contested, it could lead to increased volatility. The article points out that during the 2000 elections Florida recount, the S&P 500 dropped more than 4%, and investors rushed into safer assets, causing gold prices to spike. Another interesting aspect is the VIX, often referred to as the fear index. Historically, this index tends to rise as election day approaches and usually falls back after the votes are counted. For those with investment experience, this pattern is familiar. Anticipate an increase in the fear index leading up to the election, with a drop afterward regardless of the outcome. The article also explores how each candidate's victory might impact various markets. If Harris wins, sectors like renewable energy, electric vehicles, and utilities could benefit significantly. She's proposed offering first-time homebuyers up to $25,000 in down payment assistance and tax incentives for builders, which could boost residential construction. However, her administration is expected to impose stricter regulations on big banks, which might not bode well for the financial sector. On the other hand, if Trump wins, we could see a different set of dynamics. He's likely to escalate trade tensions, particularly with China, which could create challenges for higher revenue companies. Notably, well-known chipmakers like Nvidia might face additional pressure. However, traditional energy companies could see a boost, as Trump plans to lift restrictions on domestic oil production and reverse many of Biden's policies on electric vehicles. When it comes to bonds, both candidates seem to lack a clear strategy for controlling U.S. debt, leading to concerns about rising national debt levels over time. According to Wall Street surveys, Harris is perceived as less hostile to the bond market than Trump. In the currency market, if Harris wins, the uncertainty surrounding trade, immigration, and foreign policy could ease, which might put pressure on the US dollar, especially if Democrats control both the White House and Congress. Increased government spending could weaken the dollar as well. Conversely, if Trump is elected, the bond market might gain momentum due to potential interest rate cuts from the Federal Reserve, making bond investors happy. Additionally, Wall Street experts believe that Trump's tariffs could temporarily boost the dollar while hurting currencies like the yuan and the Mexican peso. However, Trump has also suggested that the dollar is too strong, so it'll be interesting to see how he navigates these conflicting views. In summary, the upcoming US election is a significant event that goes beyond just political emotions. It has real implications for our everyday lives and the economy. This analysis sheds light on various market factors to watch as we approach November 5th. Thirdly, let's dive into another important news story. According to a report from the New York Times, the headline reads, "Vietnam revives power-sharing arrangement with new president." Vietnam's parliament has appointed Politburo member Long Quang as the new president, taking over from the recently resigned party chief, To Lam. This move is seen as a way to strengthen collective power sharing. However, I've looked at coverage from other media outlets, and they seem to generally agree that this symbolizes a return to collective leadership. Honestly, I really disagree with that interpretation. Just because To Lam stepped down from the presidency doesn't mean he's ready to share power with the other top leaders. People who don't understand the communist system might jump to conclusions based on these surface-level changes. Take To Lam's predecessor, Nguyen Phu Trong. He also spread power around, but that didn't make anyone else a true decision-maker in Vietnam. The real decision still came from To Lam himself. I've been keeping an eye on To Lam, and honestly, his behavior and statements remind me a lot of the late Nguyen Phu Trong, if not more theatrical. It's like he's playing the role of a god or an emperor. So, the idea that stepping down is linked to restoring collective leadership or power sharing is just not true. Of course, maybe I'm just being biased or misjudging the situation. Today's fourth report from the Times of Israel has the headline, 7 Jewish Israelis arrested for spying for Iran on security figures, IDF bases. Israeli police and security officials say they've arrested these 7 Israelis on suspicion of engaging in espionage activities for Iran, allegedly in exchange for hundreds of thousands of dollars. According to statements from Israeli police and officials, these individuals are Jewish citizens from Haifa and northern Israel. They reportedly conducted hundreds of data collection missions at military bases, ports, energy infrastructure sites, and Iron Dome missile defense positions. The police have described the seriousness and scope of their actions as among the worst in Israel's history. They expect prosecutors to bring charges against these suspects in the coming days. Interestingly, 2 of the suspects are minors, and they were allegedly working under the guidance of 2 Iranian intelligence operatives. They knew that the information they were passing along could endanger national security and, in some cases, even aid enemy missile attacks. These individuals reportedly filmed and documented strategic locations and transmitted that data to Iranian agents. They're also accused of purchasing advanced equipment specifically for espionage activities on behalf of Iran. This news highlights a crucial point. While we often hear about Israel developing extensive spying networks in Iran, it turns out Iran has also been building its own spying networks within Israel. So, contrary to what many might think, Iran isn't as incompetent as some believe. Lastly, I want to share a finance report that's been generating a significant buzz in China's financial community. It explains why the Chinese government has dramatically adjusted its economic policy since the end of September. This comes from a piece by Liu Yuanchun, the president of Shanghai University of Finance and Economics. He recently spoke at the 15th Huiyang China Global Forum and provided an analysis of the Chinese government's notable policy shift, which is quite crucial to understand. For 2 years, the government has taken a cautious stance, avoiding broad stimulus measures and intentionally working to deflate the real estate bubble. The mantra has been clear: houses are for living in, not for speculation. Real estate developers have faced strict regulations, particularly through the 3 red lines policy. This was underscored at this year's Economic Work Conference, where it was reiterated that housing should serve its primary purpose. In fact, in June, Premier Li Qiang emphasized the need for measured approaches rather than drastic ones, reflecting Xi Jinping's steady resolve amid concerns about economic slowdowns. However, by late September, there was a surprising pivot. Liu highlighted that while Xi had been firm, he seemed to change his approach dramatically. The reasons behind this sudden shift remain somewhat obscure to the public. The Wall Street Journal speculated that the internal economic data might be far worse than what has been communicated externally, possibly alarming Xi, especially as some local governments are at a standstill, struggling to pay salaries for civil servants. As an insider, Liu offered an interpretation of Xi's dramatic turnaround. He pointed out that the Chinese economy is now facing a series of new challenges. Specifically, GDP growth fell short of expectations in both the second and third quarters, and policies introduced last year, including the 517 initiative aimed at revitalizing the real estate sector, failed to yield the anticipated results. This so-called epic stimulus policy hasn't managed to halt the decline of the real estate market. Moreover, while local governments have funding, they often find themselves unable to deploy it effectively, creating a frustrating situation. Liu further noted that this shift in policy direction stems from a new consensus among the Communist Party's top leadership. He explained that Xi and his team have come to recognize that stabilizing the real estate market and capital markets is vital for long-term economic health. This marks a significant change from their previous long-term strategies to a more immediate focus. Liu interpreted this as Xi's recognition that they need to prioritize short-term emergency measures over their earlier structural reform plans. The core of this new approach is to address pressing economic issues first. Liu pointed out that Xi's leadership now understands that immediate solutions must take precedence, effectively pausing the previous strategies aimed at reducing real estate bubbles and leveraging. It appears that the government is shifting to ensure short-term stability before worrying about longer-term reforms. Liu, as a top advisor within the communist framework, explained this major policy pivot by emphasizing that the current economic contradictions are so pressing they risk widespread upheaval. The priority now seems to be preserving immediate prosperity. Since 2021, it's become clear that the ongoing adjustments in the real estate sector are far from simple fixes. Comments from top officials, including the central bank governor and the head of the securities regulator, have underscored the importance of stabilizing both the real estate market and the stock market to restore confidence. Liu argues that without this confidence, short-term demand cannot be secured. He further elaborated that recent interest rate cuts by the Federal Reserve have created more room for policy adjustments in China, prompting the government to act decisively. Liu believes that the urgency of the situation has led Xi to prioritize immediate needs over longer-term goals. When discussing how to communicate these changes within the party, Liu suggested that Xi's team recognizes the need to stabilize real estate and the stock market to foster confidence and drive consumption. Essentially, everything hinges on stabilizing these sectors first. Liu characterized the recent measures as a comprehensive approach, mixing short-term stimulus with structural reform plans. He argued that this isn't just superficial stimulus, it aims for fundamental changes in behavior and incentives to reignite growth, especially since local governments have effectively gone dormant. In his speech, Liu shared 3 key takeaways that I find worth discussing. First, Liu has regularly participated in discussions led by Xi and Premier Li, which gives him unique insight into the decision-making process within the Communist Party. His recent comments offer an important glimpse into the background of this policy shift. The core issue he highlights is that local governments can no longer sustain their operations effectively, leading them to become inactive even when stimulus funds are allocated. Yet, he didn't delve into the reasons behind this inactivity, possibly due to his political position. The Wall Street Journal's analysis was more candid, suggesting that the current crisis has led to disastrous outcomes for many local governments, making their continued operation untenable. This is reflected in recent comments from China's finance minister about the 3 guarantees, which emphasize maintaining local governments' normal functioning. Second, Liu pointed out that the unprecedented real estate stimulus policy introduced on May 17 has proven ineffective, which has raised concerns for Xi. His assessment reinforces the notion that the economic difficulties within China are potentially more severe than the direst predictions from outside analysts. Finally, Liu provided a logical framework suggesting that, due to immediate challenges, the government is stepping back from its long-term reform agenda. Initially, Xi aimed for a careful deflation of the real estate bubble, but the pressing circumstances have led to a re-embrace of leveraging practices by developers and homebuyers. This indicates a major retreat from previous policy positions. In a more relatable analogy, I'd say Liu's description essentially paints Xi's recent actions as creating a significant policy abandonment. It's like Xi has reverted to a previous approach after 2 years of advocating for housing as a basic need. Whether this represents the largest policy reversal in Xi's tenure is debatable, but from an economic policy perspective, it certainly ranks among the top 3. In summary, Liu's eloquent explanations ultimately reveal that this shift represents a withdrawal from necessary reforms. It's as if someone who's managed to quit a harmful addiction suddenly relapses because the withdrawal symptoms became too uncomfortable. This might provide temporary relief, but could lead to greater long-term harm. In conclusion, while the recent stimulus measures might be seen as a necessary step, it's crucial not to lose sight of the need for ongoing reform. If we revert to encouraging real estate bubbles and rely on increasing local debt to spur development, we risk repeating past mistakes. Liu's insights shed light on the background of this policy shift, emphasizing how she is prioritizing immediate goals over long-term stability. Understanding the implications of this change is essential for evaluating its impact on China's economic future. That's all for today. Thanks so much for watching. If you found this video helpful, don't forget to hit the like button and subscribe for more updates. I look forward to seeing you in the next one.